Currently in America, about 10 companies are making up 35% of the S&P 500, just another word for the public stock market. And this overconcentration is leading a lot of investors to focus more attention on the private markets, right? Private investments. So today I'm specifically going to talk about the private marketplace. I'm going to share 4 specific private investments that you might be familiar with. I'll give them a few quick definitions, but more so than anything, I just want this to serve as an intro to private investments. There's a lot of mystery and there's a lot of mystique behind private investments. And although wealthy families have been investing in the private markets for several decades, I have to give you some of the drawdowns today, and I'll share some of the benefits. But at the same time, I just want to make this intro very educational, and I hope that if you are someone interested in private investments, that you would really do your homework and really understand the risks that come with it first. And so 2 of the main reasons that I'll get into here that people look at private investments are non-correlation and just overall returns, right? So non-correlation, let's start with that one. This is simply just a fancy word for it behaves differently than the public stock market, right? A moment ago, I mentioned the overconcentration of the public stock market. And when we talk about the difference in how a private investment performs, ideally it would not behave or return the same way that Tesla, Apple, Google, and the S&P 500 stocks would. Another interesting fact is that right now in America, when we look at companies that are above $100 million, roughly 85% of those are private, meaning there's a lot of quality companies that are not able to be accessed by an investor in the public markets, but can be accessed in the private markets if the company allows for it. So there are a lot of kind of hidden opportunities in the private space. It's just a matter of finding the right ones. The ideal benefit here, of course, is that years that the S&P 500 is down, that the private investment behaves differently and maybe has a return that year that we can depend on. This is going to allow you potentially in retirement to have a more stable income or a more stable ride with your portfolio as you grow it. Second piece that I mentioned there is returns. Every private investment in the world is going to tell you that they shoot for higher returns than the S&P 500, and that's not always the case. The S&P 500, of course, has been a significant asset builder for millions over the years, and it has done very well. So it's very difficult for any private investment to outperform it. But we do know with higher risk does come the potential for higher reward. So take that as you wish, but know that also outperforming is another potential benefit of a private investment. Before I break down some specific case examples here in a moment, let me share some of the downside. The first is going to be lack of transparency, right? These are private investments, meaning they don't actually have to provide as many information on their financials or how their business operates as Google, Apple, Tesla, companies of the S&P 500. So that lack of transparency can bother some. It's not necessarily a red flag, but no, when we talk about reporting, right? How is my investment doing? You're really only going to know about once or twice a year with a lot of these investments. If you compare that to the S&P 500, where you can check and scroll your phone all day and see how it's performing minute by minute, which actually may be better to have less access to that for some of you, there's going to be a huge discrepancy there in how it's reported. The other piece here is higher fees, substantially higher fees, right? You can get into the S&P 500 right now at a very low cost. When we talk about private investments and alternatives, the fee really can vary, but no, it's going to be significantly higher if we talk about a hedge fund, if we talk about real estate, if we talk about private equity, right? Any of these funds are going to be pretty expensive to get into. Another downside is simply how much you have to put into it just to get in the door, right? A lot of times this requires you to be an accredited investor. All that really means is that you have to have $1 million in investable assets that are not your house, or you have to make $300,000 or a couple before you're even allowed to invest in these. Now they're changing some of the rules around, which I do not think is ideal, but know that typically that's where you have to start at. And then from there, you'll have to make a minimum investment just to be able to allowed to invest in a few of these. The last piece I'll talk about here is illiquidity. I always talk about this when we talk about private investments, and that is simply how hard is it for me to get my money back after I invest in something, right? So the example I always give is if you invest in the S&P 500, you can trade that intraday, and the next day you can probably have your cash back. But if you buy a house, it's much more difficult to sell a house, at least for the cost that you bought it at, and get that back quickly. And that's a similar comparison here to private investments. A lot of these have long lockup periods, 5, 10, maybe even 15 or more years. So that money's gonna be tied up for a long time, which means you're not gonna have access to it. And for a lot of you, if we're talking about retirement, that may not be an issue at all, and that's fine. But life throws things at us that we're not necessarily ready for. If you're a homeowner, you know that is absolutely the case. If you have kids, you know that's absolutely the case as well. So a lot of times we need more access to our money than we actually know. A lot of funds nowadays are allowing you to get 5% a quarter, or maybe at the end of the year you can withdraw your money, right? They're listening to a lot of the complaints that investors have, but know that we have seen a lot of lockup periods and illiquidity when it comes to these investments. So let me introduce you to a few case studies here, right? Let's start with private credit. Now, private credit is a way that potentially you can have a stable income in retirement. Private credit is really just designed to be able to have a high yield. We often compare these to bonds. We compare this to high dividend stocks. It's a way for a retiree or someone who's just looking to add more to their income, do so in a passive way. Private equity is another one I want to point out here. This is very similar to owning a public stock, only you're just doing so in the private market, right? So you'd still want to be diversified. You'd still want to know exactly what you're owning, but it's just simply owning a private holding rather than a public one, with the goal here of long-term growth with some potential for tax deferral. Another one is real estate, which I'm sure you're probably most familiar with out of this list. And some of the main benefits of real estate, yes, are appreciation and you have a tangible asset to invest in, but there are some tax benefits to real estate, right? So we're talking about depreciation and several other factors that real estate could benefit you in. The last one I'll mention, and probably the most difficult one to get into, is venture capital. Venture capital is just simply swinging for the fences, right? Once you have enough assets built up that you are totally okay, if this money goes to zero, venture capital is where you would look to. About 9 out of every 10 venture capital investments typically fails, but that 10th one, a lot of times can net you a pretty significant return, multiples of what you put in. So those are just 4 common examples, 4 common case studies that we've seen. If you have any questions on these, please feel free to reach out to me afterwards. But for time's sake, I guess we'll keep it there. Last thing I'll point out is how much is too much, right? We don't want to be over concentrated, even if we are someone that has a high risk tolerance or someone that has enough investable assets that I am able to put money away for 5, 10, and 15 years. And if I'm willing to accept the illiquidity and the non-transparency and everything that comes with a private investment, how much is too much? There's no one size fits all answer here, so I'll kind of just give you a rough estimate. 5% is probably the conservative if you are someone that is dead set on investing in private investments, right? 5% is that kind of diversifier where it does enough to do damage, but it's not going to change your portfolio overall. I'd say anything above 10% is when you start getting moderate, and anything to 20% is when you're taking a significant portion of your portfolio and putting it in something private. So please be on the lookout with any red flags when we talk about private investments, right? Poor transparency or reporting, unrealistic return projections, misalignment incentives. I see that a lot. And then no third-party admin or no outside person that's looking at the company and seeing how valid they are and seeing their actual prospect that they're going to be what they say they're going to be. Something that I look for before ever even having the conversation with a client about private investments is, first, you have to have a stable set of assets that you can depend on for retirement, that you can depend on for your life as needed. And that sometimes can be the biggest risk of private investments, is simply not having that access after we invest. So that is it for today's video on private investments. If you have any further questions, this is a very mysterious world for a lot of you, so feel free to reach out to me. I'd be more than happy to give you a further introduction that probably fits more of your needs on a personal level. You can reach out to me here. But thank you so much for watching this video as always, and I will see you next time.